Welcome back, everyone, to the deep dive. We always like to pick a really interesting question for these deep dives.
Mm.
And today, we're going to be tackling one that really got my brain going.
Yeah.
The stock market.
Yeah.
Is it getting more or less efficient? I mean, you would think, right? More information,
Right.
easier trading.
Uh-huh.
Shouldn't the market be better at pricing things?
Hmm.
But
Yeah.
maybe not. Especially when it comes to, how different stocks are valued relative to each other.
Yeah. That's well, it's certainly a question that Cliff Asness is diving deep into in his new paper, The Less Efficient Market Hypothesis.
Okay.
And we're gonna use some excerpts from that today to kind of guide this discussion, and I'm here to help guide you through it.
Excellent. And you always do such a good job at that, breaking these things down.
Hmm.
So before we get into all the intricacies at Asness's hypothesis, I think it's important to take a step back and just think about,
Right.
what do we mean by market efficiency?
Yeah.
Why
Why should anyone care?
anyone care? Yeah.
Yeah.
Well, I mean, the efficient market hypothesis, or EMH,
Right.
is kind of the cornerstone of this
Yeah.
whole conversation, right?
Right.
And what that basically says is that stock prices
Uh-huh.
should reflect all available information.
Okay.
So,
Yeah.
in theory, you can't consistently beat the market
Right.
because
Yeah.
if there was an easy opportunity to make profits, everybody would do it, and then that opportunity would go away.
So the market's like this perfect, almost information processing machine.
Yeah, that's
Constantly adjusting
Yeah.
based on the latest news data, even like rumors.
Rumors, yeah.
Right.
And that efficient allocation of capital, that's what drives a healthy economy, right?
Right. Yeah.
Make sure that money's flowing to
Yeah.
the most promising companies and all that good stuff. Yeah, I mean, that makes sense. But how do you even go about, testing the efficient market hypothesis? I mean, isn't that kind of a...
It's a tough one.
Yeah.
And we run into something that academics like to call the joint hypothesis problem. Imagine you are trying to test whether a cake recipe works.
Right.
You bake the cake, it comes out flat. Well, was the recipe bad? Or did you forget to put in baking powder?
Right, yeah.
To really test the recipe, you have to be sure that you followed it perfectly.
Yeah, so it's like with testing market efficiency, in order to test if prices are reflecting all information,
Yeah.
you need a model
Right.
of, how that information should be incorporated into the price.
Exactly. And that's the tricky thing because, I mean, we don't know.
Right.
Human behavior is inherently unpredictable. So
Mm-hmm.
Asness kind of talks about this concept of reasonable models.
Yeah.
He uses this great example where he says, the color of a company's logo,
Shouldn't impact its stock valuation?
definitely not something I'm looking at when I'm looking at stock.
Me neither.
Okay, so where does Asness start to see signs that maybe this efficient market idea is breaking down? What are some of the things that are making him question?
Yeah, so
Quote.
one of the things he looks at, he talks about this concept called the value spread, which is basically just the difference in valuation between expensive stocks, like hyped up, growth stocks,
Right.
and cheap stocks,
Okay.
or value stocks, as we call them.
So a high value spread means that investors are
Potentially getting a little carried away. They're potentially getting a little carried away. Maybe those growth stocks are a little bit overvalued.
Okay. So warning signs almost.
It could be a warning sign, yeah.
Yeah. Okay.
So he shows this in Exhibits 1 and 2
Okay.
in his paper.
And he points out, remember the dot-com bubble?
Oh, yeah.
Back in the late 90s, early 2000s?
Yeah.
Value spread
Yeah.
went through the roof. And you know what happened?
What happened?
Value investing got crushed.
Oh.
Yeah.
So it doesn't sound too efficient.
It doesn't sound efficient when, the cheapest stocks in the market underperform by such a wide margin.
And that's not just ancient history, right?
No, this is not just ancient history.
Okay.
He shows that a similar thing happened in 2019, 2020.
Look.
Right before the pandemic hit.
Oh, wow.
So what's even more concerning, he shows in Exhibit 3 that these spikes aren't just getting bigger.
Yeah.
They're lasting longer.
Oh, wow.
Which makes it really hard for, if you're a rational investor.
Right.
You're like, I want to buy these cheap stocks, but
Right.
they keep underperforming for years and years.
Right.
It's tough. It's tough to stick to your guns.
Yeah, it's like watching a slow-motion train wreck.
It is.
You see it coming, but you're strapped to the tracks.
Yeah.
You can't get out of the way.
Yeah.
So does Asness say that these, huge value spreads are definitive proof
Well,
that the market is becoming less efficient?
I think
Or is this just a piece of the puzzle?
he's building a case here, right?
Right.
He's like a detective piecing together a
Right.
mystery.
Yeah.
And I think he's got some, some good leads, like low interest rates,
Yeah.
the growth of mega cap tech stocks.
Wow.
But he's like, there's still this gaping hole in the story. And he thinks that that hole
Right.
is shaped like decreasing market efficiency.
Mm.
It's like he can't ignore these extreme value spreads. They don't make sense with the usual explanations.
Okay, so we've got this potential market mystery on our hands.
Yes.
What are some of Asnus's top suspects?
Yeah, so he lays out
Yeah.
3 main hypotheses.
Wow. And one of them is kind of surprising.
Okay.
It has to do with indexing.
Indexing.
Yeah.
You mean like just...
Like buying and holding an index fund.
Yeah, an S&P 500 index fund or something.
Yeah.
How could that be
Right.
a bad thing?
Yeah. So on the surface, I mean, indexing is great, especially for individual investors.
Right. Yeah.
But Asnus raises this thought-provoking question. What if everyone indexes? Like, what happens then? Does it change the balance between, the sharks in the market,
Yeah.
the rational investors, and
Right.
the minnows, the ones who are driven by emotions or biases?
Yeah. So if everyone's just blindly following the index,
Yeah.
those minnows might have more sway
They might
over the prices than the sharks.
Yeah, potentially. If fewer people are actively analyzing companies
Right.
and making informed decisions, then,
Yeah.
those misguided opinions.
Driven by hype or fear or whatever,
Right.
they could have a bigger impact.
So indexing, while it's good for the average investor,
Yeah.
might have some
Might have some
unforeseen consequences.
unintended consequences
Yeah.
for the market as a whole.
Okay, so that's one hypothesis.
That's one hypothesis.
What's the next suspect on Asnus's list?
The second one he talks about is the role of low interest rates.
Okay.
And he's quick to point out
Okay.
that this one only applies to the 2019-2020 bubble.
Right.
Low interest rates weren't really a thing back in the dot-com days.
Yeah, low interest rates weren't really a hallmark of
Yeah.
the dot-com bubble.
No, but what he's saying is that
Yeah.
these prolonged periods of low interest rates might create conditions where investors behave irrationally. Think about it. When bonds are yielding next to nothing,
Yeah.
people are hungry for yield.
They're hungry. They want that return.
They want that return.
Yeah.
So they might be more willing to take on risk,
Right.
even if it means chasing those, those high-flying,
Right, yeah.
overvalued stocks.
Desperate times call for desperate measures.
Exactly.
Right. And desperate measures might be like, okay, screw it.
Yeah.
I'm buying that high-flying stock even if it's not fundamentally sound.
Right. Now, he's not saying there's a direct mathematical link,
Right.
but it's definitely something to think about.
Yeah.
It's a plausible contributing factor.
Okay, so we got indexing, maybe tipping the scales, low interest rates, potentially fueling the fire.
Yeah.
I feel like Asnus has one more hypothesis.
He does.
And this is the one that he's most excited about.
This is the one he's most intrigued by. Yes.
Yeah, okay. So lay it on me.
So this one's all about the potential downside. Technology.
Wait, technology.
I know, right?
But isn't technology supposed to make things more efficient?
Yeah.
So how could it be contributing to a less efficient market?
That's the paradox. That's what makes it so interesting.
Okay.
Right? Think about it. We have access to so much information these days.
Right.
Trading costs are basically zero.
Right.
But he's saying, well, maybe that ease of access and those low trading costs are actually creating a false sense of confidence and leading to more trading, more impulsive decision making.
Oh, so it's like information overload.
It could be information overload.
You're just bombarded.
Yeah, you're bombarded with data and opinions.
Hot takes,
Right.
signal, what's noise.
Exactly.
And, he makes this really interesting parallel between the wisdom of crowds and the dangers of social media. Like the wisdom of crowds assumes you have all these independent thinkers.
Yeah. Coming to their own conclusions. But on social media, you've got these algorithms that amplify the most extreme viewpoints.
Right.
And you get these echo chambers where independence is lost. You have what he calls a coordinated, clueless mob.
Ouch.
Yeah.
So instead of like a diverse group of investors making independent decisions, we might be getting more of this herd-like behavior.
It might be getting more driven by herd-like behavior.
Driven by social media. Hype and fear.
Yeah, hype and fear.
Right. I mean, he makes this point, and it was true back in, 2000 when he was writing about the dot-com bubble.
Right.
He said online trading is kind of like addictive video poker.
Right.
That instant feedback.
Yeah.
And the allure of quick gains.
Right.
It can lead to irrational behavior.
Or even more gamified.
I mean, it's way more gamified than it was 20 years ago. We've got, the Robinhood apps, the flashing lights, push notifications, meme stocks.
Exactly. It's all designed to make trading
more exciting, right? Engaging.
Yeah.
Which isn't always a bad thing.
Not always a bad thing.
But it can definitely, amplify those emotional impulses that lead to bad decision-making.
Emotional impulses.
Like Warren Buffett said, the casino now resides in many homes.
Yes.
And you're saying that technology is the architect of this casino.
It might be, yeah.
Even though it was supposed to make the market more efficient.
Yeah. That's an interesting paradox.
So, okay. We've got indexing, low interest rates, the unintended consequences of technology. It sounds like Asness is leaning toward the technology one.
Yeah, he finds that one the most compelling.
Yeah.
For sure.
Okay, but what does this all mean for investors, right? People who are trying to
$1 question.
Navigate this increasingly complex landscape.
Let's delve into that after a quick break.
Okay, so we've laid out some pretty thought-provoking ideas about why the market might be getting less efficient.
Yeah.
But let's bring it back down to earth for a second. What does this actually mean for investors, right?
What?
Especially those like you who are trying to take a rational, value-oriented approach.
Yeah. Well, I mean, the good news is that a less efficient market could actually mean more opportunities.
Okay.
More mispricings to exploit.
Right.
So, those clueless mobs, they might be creating more opportunities.
For people to kind of...
For the savvy investor.
Step in and profit from their mistakes.
Exactly.
So higher stakes, but...
Potentially.
Maybe bigger rewards.
Yeah, potentially bigger rewards.
For those who can keep a cool head.
If you can stay disciplined and stick to your principles.
It's like venturing into uncharted territory.
That is.
There might be gold out there.
Yeah.
But you got to be prepared for a much bumpier ride.
Be prepared for that volatility.
Yes.
Yeah.
So how are investors actually responding to this potential shift toward a less efficient market? Are they embracing the challenge, or are they,
It's interesting.
running for the hills?
It's a mixed bag, but, one response is the continued rise of indexing.
Right.
Right? People are just saying, look, this market's too crazy. I'm just going to throw in the towel and
I'm gonna just
accept market returns.
Take the market return.
Yeah, and for a lot of people...
Which, not a bad strategy.
It's a perfectly reasonable strategy.
Yeah.
Especially if you don't have the time or the...
Don't want the headache.
Yeah, just trying to...
Probably ups and downs.
Take stocks. Yeah.
Okay. There's another response that Asness finds a little more concerning.
Right.
And that's this stampede into private investments.
Private equity, venture capital.
Private equity, private credit, venture capital.
All those exclusive investments.
All those, that
promise these
the exclusive investments.
Higher returns.
Yeah, that promise
higher
smoother ride.
And a smoother ride.
Yeah.
I get the appeal, especially when public markets are feeling choppy.
But the thing about private investments is that they're not subject to that same constant price fluctuation.
Right. They don't have to mark to market.
The public stocks.
Every day.
Have, right. So, they look...
At least on paper.
They look less scary.
They look a lot less scary. It's like putting on noise-canceling headphones.
Yeah, you're blocking out the noise.
Yeah, you might block out
some
important signals, too.
Yeah, missing out on some important signals, too.
Right, yeah.
So investors are paying for this illusion of stability.
Potentially, yeah. They're definitely paying a premium.
And that illusion comes at a cost.
It could come at a cost. And Asness makes this point that, all this capital flowing into private investments has probably driven down returns.
Right.
It's a basic supply and demand thing.
So you might be...
More capital chasing the same number of deals.
A smoother ride.
Yeah.
But you might be sacrificing long-term performance.
You could be.
Okay, so you're building a house on a shaky foundation.
Yeah.
Right. It might look good for a while.
Right.
But a strong enough tremor.
Yeah, eventually.
To bring the whole thing down.
Melody catches up.
Yeah. So if these responses, indexing and hiding in private investments, aren't the answer, what does Asness say investors should be doing?
Well, he's not saying you have to abandon,
the principles of sound investing.
Right.
It's about, adapting and refining those principles.
Okay.
For this new environment.
Okay.
You got to be more discerning.
More discerning.
You got to be more disciplined.
Yeah.
And you got to be
more resilient.
More resilient, yeah.
So it's not about throwing the baby out with the bathwater.
Yeah.
It's about giving the baby some swimming lessons.
Giving the baby some swimming lessons. I like that.
Yeah. That's a good one.
So it can handle the rougher waters.
Exactly.
Yeah. So what are some of those swimming lessons? Like, what are some of the...
Yeah, he gives some concrete suggestions.
Yeah.
Number 1, embrace a truly long-term perspective.
Right.
He calls a long-term horizon.
Yeah.
The closest thing we have to an investing superpower.
Yeah, because if you're focusing on the long game...
Yeah, if
you're less likely to get spooked by those short-term...
You're not going to panic.
Yeah.
When the market takes a dip.
Right, yeah.
And he makes this distinction between what he calls statistical time and real life time. Like you can look at a back test and see, oh, this strategy's done really well over the last 30 years.
But living through
those
periods of underperformance.
From drawdowns.
Yeah.
It's a totally different experience.
It's different, yeah.
Like, it's like reading about climbing Mount Everest.
Yeah.
Versus actually doing it.
It's one thing to see a dip on a chart.
Exactly.
And it's another thing to feel that pit in your stomach when your portfolio is down 20%.
When you're actually living through it.
Yeah, yeah.
It's a different ballgame.
So it's not just about understanding the numbers.
Right.
Right. It's about preparing yourself.
It's about the mindset.
Yeah.
Mentally.
Yeah.
Emotionally.
Yeah. For those inevitable ups and downs.
You got to have the discipline to stay the course when it gets tough.
It's not easy, but it's necessary.
Step 1.
Cultivate that.
Long-term mindset.
Yeah. That Mount Everest.
That Everest climbing mentality. Yeah.
He also talks about the importance of paying attention to valuation changes.
Okay.
He points out that the U.S. stock market has outperformed pretty much every other developed market.
Right. America first.
Even in investors.
For 30 years or so.
Yeah.
Which has led some people to say, international diversification is dead.
Yeah, yeah.
But then he digs deeper.
Okay.
And he shows that a big chunk of that U.S. outperformance can be explained by a valuation change.
Okay.
U.S. stocks
just started out.
were relatively cheap.
Relatively cheap.
Compared to
other markets. And they ended up relatively expensive.
Okay.
So it's not necessarily that U.S. companies...
So it's not like U.S. companies
are inherently better.
The relative pricing has changed.
The prices have changed.
Yeah.
Oh, God.
And, to assume that that's going to continue forever.
Right.
That those valuation changes are just going to keep going in one direction.
Yeah.
I mean, that's
a recipe for...
That's a recipe for disaster.
Yeah, yeah.
What goes up can come down.
So be a critical thinker.
Yeah, be a critical thinker.
Not just a number cruncher.
No.
Don't just look at past performance.
Yeah, look at the deep...
But the underlying...
driver...
And try to understand why those numbers...
why things are happening.
Right?
Yeah, exactly. Yeah. And then another suggestion he makes is to shift your focus away from individual line items and more toward.
So line items are like asset classes or...
Different asset classes.
Geographic regions.
Different geographies.
Investment styles.
Different factors, and more toward the overall portfolio.
Okay. So don't get too hung up on how each individual...
In a well-diversified portfolio.
Piece of your portfolio is doing.
Yeah, there's always going to be some parts that are doing well and some that are...
That are lagging. Zoom out. Focus on the big picture.
Zoom out.
How's the overall portfolio doing?
Look at the forest, not the trees.
Right.
He gives the example of those two value debacles we talked about, like 1999, 2000, 2019, 2020.
Right.
Value got hammered during those periods.
Right.
But guess what?
Yeah.
The overall market did pretty well.
So even though value was lagging,
your portfolio as a whole
wasn't doing too bad. Yeah.
And conversely, when value recovered in the following years, it was often during periods
when the overall market was of weaker overall market performance.
Yeah.
So those diversifying line items, even though they might
underperform
sometimes, they actually help
smooth things out over the long run.
Yeah, smooth out those overall portfolio returns over time.
Over time, yeah.
Okay.
And then he makes this kind of counterintuitive suggestion, which is that you should actually be more aggressive.
More aggressive, but you just said, we got to embrace this long-term perspective.
With those spooked by
with those diversifying
term
line items, especially the ones that are highly
uncorrelated. You're saying we should be more aggressive with certain parts of our portfolio.
Yeah, and I know it sounds kind of counterintuitive, but he's basically saying, maximizing compound return is crucial, right?
Right. Volatility detracts from those returns over time.
Right.
So, that's the argument for not taking too much risk.
Yeah.
But he's saying that logic applies primarily to the overall portfolio.
Yeah.
Not necessarily to these smaller
independent pieces.
Yeah, imagine an investment that has a 23 chance of doubling in value.
Okay.
And a 13 chance of going to 0.
Nobody wants.
You wouldn't want your whole portfolio in that, obviously.
Yeah, of course not. Yeah.
But having a small allocation to that within a diversified portfolio could actually enhance.
Yeah. So even though
overall returns,
it might go bust. Sometimes those times when it doubles, it's really going to supercharge the performance,
really juice the portfolio returns. And his point is that investors are often too conservative. With those diversifying
items.
They focus too much on minimizing volatility within each individual holding.
So it's about finding that balance.
Yeah, find that sweet spot between
prudence.
Yeah, prudence.
But also boldness.
Boldness, yeah. Don't be reckless.
Don't be reckless, but don't be afraid to take some calculated risks.
Take some calculated risks,
Yeah.
Especially in those smaller corners.
Portfolio. More independent corners.
Yeah.
Okay.
Now, another thing he kind of rails against is this tendency to chase performance.
Over
3 to 5 year periods.
3 to 5 year periods.
You see this all the time, right? Whatever's been hot, investors pile into it.
Buying highs, selling low.
Yeah, basically.
Yeah.
And he's saying, look, over those longer time horizons, that's actually counterproductive.
Yeah, so it's about resisting that herd mentality.
He's saying, be a little bit contrarian.
Yeah, having the courage to to zig when everyone else is zagging.
Look for those undervalued opportunities.
But that takes
everyone else is ignoring.
A lot of
conviction. It takes conviction.
Go against the grain like that.
And he admits it's not easy.
Okay, so we've covered a lot of ground here.
Yeah.
Embrace a long-term perspective.
Yeah.
Understand
valuation changes.
Valuation Focus on the overall portfolio.
Be more aggressive with those diversifying
line items.
Yeah.
Resist the urge to chase performance.
Resist that urge to chase performance.
It sounds like a solid game plan, but also a lot of work.
It's not a magic formula.
So asness isn't sugarcoating
Easy button here. You got to put in the work, but
he's saying that, by developing the right
mindset,
skills,
discipline, you can not only survive, but thrive.
You can thrive in this new landscape.
The landscape.
Well, on that note, why don't we move on to our final part?
Okay.
Where we'll kind of wrap up this whole
sounds good
deep dive and leave our listeners with some, key takeaways.
Yeah, actionable takeaways.
That they can use on their own investment journey.
Absolutely.
Okay, so we're back for the final part of our deep dive into this less efficient market hypothesis.
Yeah.
We've gone over, what is market efficiency? What are some of Asness's ideas about what might be causing this shift?
Right.
But let's kind of bring it all together. What are some actionable
what are
the takeaways for our listeners?
Key takeaways here. Yeah. What's the
I think the big picture message is that, market efficiency is not this static concept.
Right.
It's not set in stone.
Right. It changes and does change over time.
Right.
And, as Asness is arguing, I think there's a pretty compelling case to be made that the market might be getting less efficient, at least when it comes to how stocks are valued relative to each other.
Which means, there might be more opportunities out there.
Yeah, there could be.
For those savvy investors.
More opportunities to outperform.
To really kind of find those hidden gems.
Yeah, if you can. If you can find those mispricings.
Yeah.
Yeah.
But like you said, more opportunities also means more risk.
Also more risk, right? If the market's being driven by,
yeah,
more emotional,
more social,
less rational.
Yeah, those periods of underperformance they could be worse.
Right.
And they could last longer.
So patience and discipline.
Patience and discipline.
Those aren't just buzzwords.
They're essential.
Those are survival skills.
Yeah,
in this environment. You got to have them.
Don't get spooked.
If you wanna
by those market swings.
Succeed in this environment.
Stay focused on the long game.
Stay focused on the long game.
So build a
robust, diversified portfolio. Don't try to time the market.
Right.
Don't chase the latest hot trends.
Just build a portfolio.
Build a portfolio that aligns with your
That's right for you.
Goals, your risk tolerance.
Yeah.
Your investment philosophy.
Don't be afraid to rebalance.
Rebalance as needed, yeah.
Yeah, to keep it aligned.
Exactly.
So you said earlier that Asness is a little wary about private investments.
Yeah.
Which have become very popular these days.
That people are using them to hide from volatility.
So they're not really investing in them for the right reasons.
We're not investing in them for the right reasons. They just want to sweep the volatility under the rug.
That volatility of the public markets.
Right.
And so, maybe paying a premium for that illusion.
And they could be paying a premium for it.
Of stability.
Which, might hurt them in the long run. Transparency, a clear understanding of risk.
Yeah, those are crucial.
Those are important when you're evaluating any investment.
For any investment.
Yeah.
Public or private.
Okay, so in a less efficient market with more opportunities.
But it's
a double-edged sword.
More potential pitfalls.
Yep.
How can investors
stay
ahead of the game?
I think continuous learning is more important than ever.
Yeah.
The market's always evolving.
So you got to evolve with it.
Right. Never stop learning.
Don't get stuck in your ways.
Never stop challenging your assumptions.
Yeah.
And never stop refining your process.
It's not just about sticking to your guns. It's about making sure those guns are
loaded with the right ammunition.
Loaded with the best possible ammunition.
I like that. Yeah.
Right. And speaking of ammunition, Asness had some interesting thoughts about how quantitative investors
are the quants adapting to this new landscape.
Yeah.
Well, they're incorporating all sorts of cutting-edge techniques.
Right.
Machine learning.
Yeah.
Alternative data. Factor momentum.
It's fascinating how technology, which Asness sees as like a potential driver of market inefficiency, is also being used. To like navigate that very inefficiency.
To navigate that inefficiency, it's a bit of a paradox.
Well, I think we've covered a lot of really interesting ground today.
I think so too.
It's a challenging time.
It is.
But
it's also an exciting time.
An exciting time to be an investor.
Yeah, the potential rewards might be bigger, but the risks...
But the stakes are higher.
Are higher too.
So, you got to approach investing with a...
Clear head. Long-term perspective.
And a willingness to adapt and learn.
Yeah.
Yeah, that's a great point to end on. And just a reminder to our listeners, this deep dive was just kind of a taste.
Yeah, it's just a glimpse.
Of Asness's really interesting work.
Yeah, definitely encourage you to...
We encourage you to read his full paper.
Read the whole thing.
Yeah. And we'd love to hear your thoughts.
Yeah, connect with us.
Connect with us on social media.
On social media or through our website.
Let us know what you think about all of this.
Yeah, let us know.
Until next time, happy investing.